The 4-year crypto cycle was a lie. And if you're about to sell your crypto because you think the recent cycle just ended, you're about to become the dumb money for the institutions. And I'm not saying this to be dramatic. I'm saying this because the stakes have never been higher. Because if you get this wrong and you sell your Bitcoin now because you think a time-based bear market is starting, you'll be selling at the exact bottom and right before the biggest liquidity explosion we've ever seen. And if you've held your crypto throughout the entire year and you sell now, you're probably selling at a big loss. And you're not the only one, because it's true. In the last 3 halving cycles, Bitcoin did top roundabout now, roundabout at the end of Q4 of the post-halving year. And after it topped, we did get a long bear market with an 80% drawdown. And so the consensus trade, the one everyone's talking about, is that it's the end of the cycle. And by the end of the cycle, they mean the halving cycle. They don't mean the business cycle. They don't mean the macro cycle. They don't mean the liquidity cycle. They mean the halving cycle. But all these analysts are missing one very key point. And whilst in the 3 crypto cycles that we have had, the data lines up exactly with the halving cycle, the halving cycle isn't really the main driver for the cycle. It was a coincidence. And it lined up perfectly with all the other cycles. And that's what I want to show you in this video. But first, please, do me a favor. If you're enjoying this content, please like this video because it really helps me get distribution. And if you're not already subscribed to this channel and this video blows your mind, well then subscribe to the channel and join us on this amazing, amazing journey. We're building the most profitable community in the world and we want you to be a part of it. All right, now let's go back and talk about the halving cycle. For the last decade, Bitcoin has followed a very predictable pattern which timed perfectly with the halving. Every 4 years, the rate at which new Bitcoin get created gets cut in half. That halving of the supply entering the market creates a supply shock. And when it does, the demand increases. And so the price goes up. And as the price goes up, more players enter the market. And as they do, the price gets more heated. And eventually, about 530 days after the halving, the hype pops, the market collapses, and we go into a 1-year-long bear market. And for the last 3 cycles, this pattern was extremely predictable. A 530-day bull run starting at the halving and ending roundabout now in Q4 of the post-halving year. And so with 3 full cycles of data, analysts have concluded that the halving is the cause for the cycle. And at face value, it feels correct. And it makes us feel safe because it makes the market feel predictable. But anyone that knows anything about statistics will tell you that 3 batches of data isn't a significant sample size. And that this pattern, which is based on just 3 cycles, may actually be coincidental and probably requires more research into the data. And that's exactly what I did. I pulled out the data, not the crypto data, but I looked at the macro data. I looked at the liquidity data. I looked at the stock market data. And I looked at the political data. And I added them all together and I put them onto one chart, one model. And what I found shocked me. The halving cycle definitely played a part, but it was a small factor. The real increase in the Bitcoin price wasn't driven by the halving. It was driven by something much, much bigger. Something that happened in all 3 cycles, but hasn't happened in this cycle yet. And if I'm right, then it's about to happen in this cycle. And when it does, we should get the same violent increase in the Bitcoin price, just like we saw in the last cycle. And this time, it starts after the traditional 4-year halving cycle. Let's look at the data. Let's go back to 2013. After the first halving in November 2012, Bitcoin rallied from $10 all the way to $1,250. And it peaked 1.5 years after the halving in December 2013. And everyone said, it's the halving. But here comes the alpha. Starting in December 2012, the Fed started quantitative easing. They started adding $85 billion worth of liquidity into the market every month. And over a year, they added over $1 trillion worth of liquidity into the market. And when they did, Bitcoin went from $10 to $1,250. But starting in December 2013, they started slowing down quantitative easing. And when they did, that's when Bitcoin started falling from $1,000 all the way back down to $400. By October 2014, quantitative easing had officially ended, and that's when the market fell down an extra 60%. During this period, Bitcoin fell from $400 all the way back down to $150. It lines up perfectly with the halving cycle. The same thing happened in 2017. Bitcoin went on a monster rally. It went from $1,000 all the way to $20,000. And it started on December 16th. Why? Because central banks were expanding their balance sheets. In 2017, while it wasn't the Fed printing money, all the other central banks on earth started printing money. The European Central Bank was running one of its biggest quantitative easing programs in history, $80 billion a month. The Bank of Japan was buying bonds and ETFs at an unprecedented rate. China unleashed the biggest credit impulse in history. So even though the US wasn't necessarily doing QE, worldwide central banks were building QE and their balance sheets were growing. Nearly $2 trillion was added to their balance sheets between 2016 and 2017. And that wall of money, that pushed Bitcoin from $1,000 to $20,000. And again, it lined up perfectly with the halving cycle. And then we moved to 2020.
Today, the World Health Organization officially announced that this is a global pandemic. This is the most aggressive and comprehensive effort to confront a foreign virus in modern history.
This one was the most obvious one of them all. What did the Fed do? Well, when COVID hit, the Fed launched the biggest QE program in history. Quantitative easing started on March 15th, 2020, when Bitcoin was around $4,000. The Fed printed trillions of dollars, and they expanded their balance sheet by over $5 trillion. The biggest global liquidity injection in the history of finance. And it wasn't just the Fed. The ECB was doing the same thing. The Bank of Japan, $100 trillion Japanese yen injection. The People's Bank of China doing exactly the same. And so what did Bitcoin do? Bitcoin went from $4,000 to $69,000. And it timed perfectly with the halving. The pattern is clear. The business cycles are driven by liquidity. If you increase money supply, economies expand and prices rise. And in the last 3 cycles, it just happened that that increase in liquidity corresponded with the halvings. And that's exactly what you see when you look at this chart. The halvings coincidentally timed exactly with the increases in liquidity and the related economic expansion. There's one key metric that tracks this expansion, and it's called the PMI. The PMI measures the global business cycle. It measures whether the economy is expanding or contracting. If the PMI is above 50, the economy is expanding. Companies are hiring, borrowing, producing, and taking on new orders. If the PMI is below 50, the economy is contracting. Companies stop hiring, they cut orders, they reduce production, and they stop borrowing. Liquidity dries up and risk assets struggle. The PMI follows the liquidity. When liquidity hits the system, the PMI turns up from the bottom. And historically, this is exactly when Bitcoin has its strongest rallies. Not the halving, not on the calendar, but when the PMI bottoms and starts rising. Let me show you what I mean. If we look back at the previous halvings, the 2016 halving happened in July 2016, and this lined up perfectly with the PMI bottoming between July and August. And the PMI started to expand, and it started expanding in September 2016. Total coincidence, right? Okay, let's go to the 2020 halving. The halving was in May 2020. Now let's look at what the PMI was doing at that time. Boom. It bottomed out exactly at 41 in May 2020. And since then, it started expanding. Another coincidence, right? At this point, it can't be a coincidence, right? In the last 2 bull markets, the liquidity increased and the PMI started to expand. And when the PMI finally broke 55, that's when crypto started to move. That's when the real bull market started. Let's look at the 2017 bull market. When the PMI broke over 55, that's when Bitcoin started to go from 1,000 to 20,000. And in 2020, when the PMI broke over 55, that's when Bitcoin started moving from $10,000 to $69,000. First, liquidity flowed into the economy, then into the markets, and then Bitcoin and altcoins started to run. In fact, as soon as the PMI hit 60, that was when the altcoins started to move. Just look at the 2017 bull market. First, Bitcoin started moving when the PMI broke 55. And then, when the PMI reached 60, look at what happened to the altcoins here. The total 3 chart, which is a chart that measures crypto, which excludes Bitcoin and Ethereum, went up by over 10x. And it's not just in 2017. Let's look at 2021. Bitcoin also started moving when the PMI broke 55. And as soon as the PMI reached 60, total 3 jumped by more than 9x. So the pattern's incredibly clear. Every cycle follows the exact same sequence. When the PMI breaks above 50, the economy exits contraction. That's when the liquidity starts returning. That's when Bitcoin bottoms. When the PMI breaks 55, liquidity accelerates. And that's when Bitcoin begins its real bull runs. When the PMI pushes above 60 and the system enters full expansion, that's when the altcoin supercycle starts. But this time, the Fed cycle and the PMI didn't line up with the halving. This time, for the last 2 years, the Fed has been draining money out of their system with quantitative tightening. And with this liquidity missing from global markets, the PMI has been flat and maybe a little bit down. But all that's about to change, because at the last Fed meeting, Powell said that in December, the Fed tightening cycle would end, and that they would shift from a tightening cycle to a loosening cycle. Quantitative tightening ends. There's going to be lower interest rates. And eventually, we'll move to quantitative easing. This is huge because it marks the second time in history that this has ever happened. It's the same loosening liquidity cycle we saw before, but only this time, it doesn't correspond to the halving. It starts 1 year later. And when it does, the economy should enter the expansion. And when it does, the PMI will move again. And when the PMI moves, that's when the Bitcoin and the altcoins will start moving. The key point is clear. We have never entered a bear market in a period where liquidity is expanding. Never. Not once in history. I'm going to repeat that. We have never entered a bear market in a period where liquidity is expanding. And it makes perfect sense because more liquidity equals more money in the market, and that's more money in the economy. And that money flows to risk assets. Then we need to look at this cycle. The data shows that this cycle is powered by institutions. This is the first cycle where TradFi money is entering crypto via ETFs, DATs. And when I say entering, the flows are huge. Way bigger than any flows that retail investors can bring. Now ask yourself another question. Do you think these guys will sell their Bitcoin because the 4-year cycle days are ending? If the economic conditions are loosening, if the money print is on, and if the business cycle is expanding, do you really think that these buyers are going to dump Bitcoin by 80%? Let me explain to you how TradFi works, right? TradFi has 2 modes, risk on and risk off. And when the money cycle is expanding and the PMI is going up, that's when it's risk on mode. Do you think Larry Fink has a rainbow chart on his wall? Do you think Larry Fink cares about the 4-year cycle? He doesn't. But I guarantee you he's watching liquidity. I guarantee you he's watching the Fed balance sheet. I guarantee you he's watching economic expansion. And I guarantee you that he's watching the PMI. So if we're entering a period where the global money supply is about to go up, the institutional algorithms are going to be on the risk on side, on the buy side, regardless of how many days since the last Bitcoin halving. So here's where it gets dangerous for you, and where a lot of people are about to lose a lot of money and to lose the entire cycle. The halving clock and the liquidity clock were correlated for 3 cycles. But this cycle, they're decoupled. And that's what's confusing markets right now. For the last year, everyone's been waiting for or trying to believe that we're in a bull market. But the data says we haven't been in a bull market. Bitcoin is now lower than it was when we started the year. It should have been a bull market, but it wasn't. And the reason why it wasn't was because the liquidity cycle and the expansion cycle said no. And so here we are. The 4-year cycle, that's over. In fact, I don't know if it ever existed. But the liquidity clock, that hasn't even started ticking yet. And that's why we've been stuck in this boring phase for so long. With so much new demand in an asset, and an asset that now has a market cap of $2 trillion, with the amount of supply the halving reduces, that is now irrelevant. And so the Bitcoin halving event, that's become irrelevant. What is relevant is global liquidity. And that's the only metric that matters. This cycle isn't over. In fact, if anything, this cycle hasn't even begun. Over the next few months, QT will end, interest rates will go down, Trump will elect a new Fed chair, and the economic cycle will start to expand. When it does, the PMI will start to fly. And that's when the real move will start. So I know this correction feels scary. And I know it's been a tough and bumpy ride. But if you sell your Bitcoin and crypto assets now because you're scared of this 4-year cycle ghost, you'll be selling your coins literally at the bottom. And you'll be selling them to institutional players just before the liquidity cycle starts. And you know why? Because they know the cycle better than you do. So listen, I'm not selling. I'm looking at the Fed. I'm looking at global liquidity. I'm looking at economic expansion, and I'm looking at PMI. And as long as the money is flowing into the system, I'm buying or I'm holding. And then what I'm doing is I'm waiting for the rest to realize that the 4-year cycle was just a coincidence. The 4-year cycle was a lie. Don't let them scare you out of your position. I'll see you in the next one. And if you enjoyed this content, like and help me get distribution, and subscribe to this channel and join the most profitable community in the world. I'll see you again soon. Until then, trade well, my friends.